This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 43. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review the Planet MicroCap Podcast on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with Ben Carlson, author of the book A Wealth of Common Sense. I picked up Ben's book not too long ago and found it very useful and informative. The overarching theme throughout the book, as it states on the cover, is answering the following question: why simplicity trumps complexity in any investment plan? I thought this would be a great topic to discuss with Ben for the podcast. The goal for this episode is to understand why simple solutions can be used to solve complex problems. As Warren Buffett states, investing is simple, but not easy. Thank you again for tuning into episode 43 of the Planet MicroCap Podcast. Please enjoy my interview with Ben Carlson, but first, a word from our sponsor. Hey everybody, Robert Kraft here, your host on the Planet MicroCap Podcast. I'd like to take this moment to invite you to join me and some of the guests you may have heard on this podcast to our annual Microcap Investor Conference, the Planet MicroCap Showcase, April 26th through April 28th, 2017 at none other than the Planet Hollywood Resort and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you'll get to meet privately in one-on-one meetings with company management of undiscovered and well-known microcap companies. There are a lot of surprises in store, and you're not going to want to miss it. So join us at the Planet MicroCap Showcase, April 26th through April 28th at the Planet Hollywood Resort and Casino in Las Vegas. For more information, go to www.planetmicrocapshowcase.com and register now to reserve your spot. See you in Vegas. For this episode of the Planet MicroCap Podcast, I have Ben Carlson on the program. He is the author of the book A Wealth of Common Sense. Ben, welcome to the Planet MicroCap Podcast.
Glad to be here.
It's great to have you on. So to get started, what is your background and experience with microcap stocks?
Well, I've spent a ton of time studying, financial market history, and one of the things you learn once you realize how different stocks perform is that there's definitely this sort of small cap premium, and it can be argued for the reasons why. I think part of it has to do with the fact that there's a longer runway with these stocks. They might be a little riskier. They have less coverage by Wall Street analysts, and there's obviously more opportunities because there's larger number of smaller stocks, depending on how you define it. And so I've definitely spent my time, sort of tilting my portfolios, personally and professionally, to sort of smaller cap stocks. I dabbled a little bit in sort of stock picking early in my career, realized it just really wasn't for me. So now I'm more of a basket holder of stocks, if you will, of these smaller names, in a diversified approach. But I definitely think it's an interesting space, and maybe one of the few places left in the market where you can really find an edge.
The main reason I wanted to have you on today is that you are the author of this book called A Wealth of Common Sense, which I read, and it's great. And I wanted to know, why did you write A Wealth of Common Sense?
Well, I've been in the finance industry for probably close to 12 years now, and I get a lot of questions from friends and family members and people outside of the world of finance. And for people on the outside looking in, it seems like a very complex place. It's kind of hard to understand. There's a million different voices out there trying to tell people what to do. And my whole thing was just try to explain the financial markets and the investment process in plain English, so people can understand them. So actually, before I wrote the book, I asked Jason Zweig, who's a longtime columnist for the Wall Street Journal. I said, what should my goal here be? How should I approach this book? Because I've never been much of a writer. I want to sort of get my ideas out there. And he kind of told me, imagine that your grandmother came to you and wanted to know 10 things about investing that she could both understand and that she needs to understand. And what would you tell her? And that was kind of a great way to frame it is how do I take these complex topics and make them simpler for people to understand? And what I found is that my audience I was hoping to help out people who are not in finance, but I've actually found that a lot of people inside the world of finance have been drawn to the ideas too, because a lot of them need to learn how to more effectively communicate with their clients or their prospects, and sort of helping them understand. So I think the idea was really to just take these complex problems that I don't think really require complex solutions, and explain them in plain English to people.
Mm-hmm. And just to give an example, before we get into the nitty gritty of the book itself, what are some examples of these like complex problems, or these seemingly complex problems that people think that they have to have these complex solutions for? Because I mean, especially within our millennial generation, you think about Wall Street and you're like, oh, this all just seems so esoteric and difficult, when if you pick up A Wealth of Common Sense, it's really, if you read through, you see that it's really not.
Yeah, well, I think the hardest part, so the old Buffett quote is something along the lines of investing is simple but not easy. And so I think it's tough for people because they assume that they have to make it sophisticated and complex to succeed, and they have to change strategies with every different macro environment. And every time the stock market changes regimes, they have to try something new, and they have to invest in the hot, the best performing funds or the fat ETFs. And so I think it's just hard for people to stick with one approach. And they assume that they need to constantly be morphing and changing their strategy. And what that usually leads to is a performance chase. And most of the time people end up fighting the last war instead of getting ready for the next one, or just it's really hard for people to just sit still and stick with one overarching philosophy. Because they assume that things are constantly changing and different, and so it's hard for people to be consistent in the markets.
Mm-hmm. So getting right into we're almost going to go chapter by chapter, because there's so much in each part, and I want to cover as much as we can, but I know it'll be difficult to cover everything, but I think we'll do the best we can. So to start off, what are the 4 basic abilities that all investors must possess in order to be successful?
Yeah, and I kind of borrowed this from William Bernstein, who is another author who I think does a great job of explaining things in sort of an easy to understand manner. And he wrote this in his book, The Investor's Manifesto, which is a really good one. He wrote it right after the crisis. And I think he was trying to kind of explain to people, what's going to happen now when people were really worried about how the financial markets were going to react. But so he laid out 4 different things, and the first one was pretty simple and common sense. And he said, you need to possess an interest in the process. And obviously that seems obvious to people. If you don't enjoy something, you're not gonna do a very good job at it. But he said, his quote was that people enjoy finance about as much as they enjoy getting a root canal at the dentist. So for a lot of people, it's tough to have that interest. The other simple one is just that you need some sort of math horsepower. And so I think you need to understand the laws of probability and statistics. And the reason for this is because, as everyone knows, the future is always uncertain. So anyone, I think, who goes into any investment with 100% certainty is bound to be disappointed, because you just never know what's going to happen. There's just a lot of luck involved in the markets, and a lot of stuff that's out of your control. So I think you have to understand how to think in terms of probabilities and make good decisions based on those probabilities, understanding that you're never going to be right all the time, but I think if you're right most of the time, that's about as much as you can hope for. The third one was just a firm grasp of financial history, and I think a lot of people miss this one. I think it really makes sense to understand things like the Great Depression, the 1987 crash, the 1980s and 90s bull market, the 1960s bull market, and I could go on and on. and the thing that you learn from studying all these things, it's tough when you're not there at the time because experiencing them at the time is much much more powerful. But my takeaway is that things are both always and never different this time. That's one of the famous quotes that John Templeton said. The 4 most dangerous words in investing are "this time is different." But the thing that I take away is that it's always different because things are constantly changing and evolving. But it's never different because human nature is the same, and so things are always going to go a little further in each direction than people would assume the fundamentals would dictate. So I think it makes sense to understand that the sort of cycle of fear and greed can take things much further than you would think possible. And then finally, the last one is just bring it all together. Even if you find it enjoyable, you're really good in math, you understand financial market history. If you don't have the emotional discipline to execute your plan, come hell or high water, it's going to be tough because the greatest investment strategy in the world is all for naught if you're not able to follow it. And so I think a lot of times they say the old statement is that the enemy of good is perfect, and people trying to implement the perfect investment strategy is tough because it's hard for people to stick with it. Mm-hmm. So those are the kind of 4 abilities that Bernstein laid out for us.
Why do you think it's so difficult to follow, for some people to follow, like even if they've gone through even a bull and a bear market, and they saw their philosophy works, but yet still I would say within some people's psychology, they think they now have to change because it might be a new type of bull market or a new type of bear market. Like what is it in that? And I think you talk about it in the book a little bit when it comes to psychology, the psychology of an investor. What's your take?
Yeah, it's tough, and I think one of the tough things these days, and obviously I think it's in our human nature to be a little biased in this case, in that we're always kind of trying to make these short-term decisions with long-term capital. But part of the problem, I think, is that there's so many choices these days, and it's both a blessing and a curse because it's never been cheaper for investors to invest, as far as trading commissions and ETFs and index funds and mutual fund fees, and everything is coming down, seemingly by the week. And it's a great thing that, we now have much easier access to the capital markets than we did in the past, and in different strategies and different information and research and analysis we did in the past. But it's always kind of, chasing the hot dot where there's always something new and tempting to go into. And so it's really tough. I think one of the hardest things to do is to do nothing. And I like to say that, doing nothing itself is a decision. And it's hard for people to just sort of sit on their hands and not do anything when that's what your plan tells you to do, and just have some patience and relax, because there's always something that's someone's going to be getting richer than you at any moment during the day. And it's really tough for people to sit there and see that and just stick in their own sort of circle of competence.
Mm-hmm. Yeah, like the worst is when you hear, or the worst is when like you had an idea and you just didn't pull the trigger, and you're just like, damn, like,
yeah,
anyway.
Yeah, no, I like to say that, like, the way I explain it to like clients is that investing in itself is a form of regret minimization, because you're always going to regret something. Either you're going to regret not being in enough, you're going to regret being out too much of the stock market, you're going to regret some of your losses, you're going to regret some gains that you didn't make. So I think it's really tough to find that perfect balance and equilibrium of just sort of balancing out that regret to the point where you're going to understand that there's always going to be more opportunities, and you're not going to be able to hit them all. But it's a tough position to be in.
I gotta say, I know we're only like about 10 minutes into this interview, but you just said the line of the interview just now. I'm about to use that on like everything. The investing is about regret minimization. I love that line. That's so good.
Yeah. I can't exactly take full credit for that. I think I actually read that from Jeff Bezos, but I'll it's sort of standing on the shoulders of giants, I guess. But it is a perfect analogy, I think, because people look at it in the other way instead of sort of doing the Munger where you invert and try to look at things from the backwards perspective.
Right. So in chapter 1, I've discussed this topic a couple of times with various guests as well, and especially as it pertains to microcap stocks. In your opinion, who has the advantage, institutional or individual investors? And does Mr. Market favor one over the other?
Yeah, well, I think there's definitely differences, and the way I like to approach it is looking at the mistakes that people can make, and I think that individuals, it's for most individuals, it's typically ignorance that gets them in trouble. They either don't have enough time or they don't have the skill set to approach the markets. And with professional money managers, it's typically the other end of the spectrum where it's overconfidence, and so they think they're too good or too smart. So I think for those individuals who can sort of put in the time and effort, there's definitely some advantages there. And like if you're talking about the microcap space, I mean, first of all, that's a place where most institutional investors can't go. So my career has been spent in this space, and you have these billion or multi-billion-dollar funds, and if they're investing in smaller or microcap companies, they really just can't they can't move the needle because the space is too small. And so it's hard for them to invest too much money in this space. So they really can't do it because it would be such a small allocation. So most institutional investors actually ignore this space or underweight it. So I do think that there is some opportunity there, and I think that the last true remaining edge in the market is just having a long-term time horizon, and I think a lot of professional money managers aren't allowed that because of career risk, and so they're constantly chasing monthly or quarterly performance numbers. So I think as an individual, your opportunity really is to have that long-term mindset, because I think it's the one thing that can't really get arbitraged away by computers or algorithms or professional investors who are acting on better research and analysis and information.
Mm-hmm. So Ben, I mean, Ben, you're as you said in your intro, you're more on the institutional side. Like, how do you reconcile this? Because you're fully aware of the of the advantage to having more of a long-term strategy versus not. What's your take on that?
Yeah, it's tough. I mean, part of it really is just sort of about understanding yourself, and I think with a lot of professional funds, when you're dealing with them, I think a lot of it has to do with effective communication and just helping them understand the pros and cons of certain strategies, and understanding when it makes sense to do something and when it doesn't. And I think half the battle is having a plan in place in the first place, and having things documented to understand when you'll act and when you won't, depending on what happens in the markets. So I think if you can sort of document your process ahead of time, and know when you're gonna act and when you're gonna sit on your hands, I think that helps a lot. But I think it's sort of an ongoing communication thing where you're really consistently hammering home your process and your philosophy, and getting people on the same page with you.
Mm-hmm. So, so in the next chapter, you talk about some of the positive traits required to be a successful investor, and then inversely, you talk about some of the negative habits investors fall into. And we talked about a few of these on the negative side. So, maybe just what are some of the main, both on the positive side and the negative side in terms of the traits that investors, a successful investor should have, and bad investors sometimes exhibit. What are some of these traits?
Yeah, I think the first one is just this idea of emotional intelligence. So, I think people worry too much, especially in the finance realm, about being the smartest guy or gal in the room. But I think at a certain point, having that high level of intelligence, I think there's a law of diminishing returns there, where it matters much more your emotional intelligence, your temperament, your self-awareness, your ability to have discipline and patience, because of course nothing works all the time. So I think having that sort of temperament to be able to sit through and be calm during periods of chaos when other people are sort of losing their mind, I think it's hard to quantify that. I think the other big thing is my favorite saying is that the three most important words in investing are "I don't know." So I think it's hard for people with a really good education and working with really smart people in the investment world. People want to be an expert on all things, and I think you don't have to do that to succeed in this game, because as long as you know your sort of circle of competence and know what you don't know, I think that's a huge edge in just sort of filtering out things that don't really make sense to you to invest in. And I think that helps a lot, sort of get rid of a lot of the noise out there. As far as the negative side of things, and I used a quote from Munger in this, which I like. He said, if you can get really good at destroying your own wrong ideas, that's a great gift. So I think half the battle is is just avoiding mistakes instead of trying to be, a world beater in the markets. And so I think it kind of comes down to a little bit what we've talked about. I think people really want to just get rich quickly, and it's hard for people to take a long-term approach and allow compounding to work in their favor because it takes a long time to see the fruits of your labor from that. And I also think a lot of people take the markets personally. If something goes in their favor, if something goes wrong, a lot of people tend to ascribe, their great investments to skill, but their poor investments to bad luck. So I think it's hard to take the market personally like that. The market is not out to get you. It's going to do what it's going to do. So you have to invest sort of as it is and not as you wish it would be.
Mm-hmm. What would you say of all the because I kind of want to hit more on this the emotional intelligence, because I feel like that's something that as an individual investor especially, I feel like that's one that a lot of people are most either susceptible to, or they have a high degree of it that helps them along the way. So can you speak a little bit more to this? What type of emotional intelligence are we talking about? Maybe an example or something?
Yeah. I think just having a good understanding. I think self-awareness is one of the biggest things, in just understanding how emotions affect you and how they affect other people. So, I think it's good to know yourself, but you also have to know how other people are going to react to the markets, and pretty much not allowing yourself to get drawn into that sort of herd mentality. So I think you have to sort of have some self-reflection and self-regulation, and sort of understanding the ability to control your impulsive decisions, which is tough. It's tough to look yourself in the mirror and say, I know here's my limitations. I know I'm not good at this, so I probably shouldn't try to do it. That's kind of a tough conversation to have with yourself. So I think that self-awareness and understanding where your strengths lie and where your weaknesses lie, I think that's a big part of it.
Mm-hmm. I remember last year, like for instance, because usually you're kind of faced with this issue during maybe there's a big international crisis, or something happened abroad. Like for instance, I remember last year with Brexit, you saw the market dip like 600 points or something like that, and you kind of have, it's like a test in and of itself. Like, okay, what do I do in moments like these? Would you say like that's when usually you're faced with those types of but I mean, for some life altering decisions, but others like, okay, this is happening. Let's take a second. What's going on here?
Yeah, and I think that's where the whole idea of like having a process over outcomes mentality works, because the problem with the markets is you're never going to have that counterfactual. Like let's say the market did crash 20 or 30% following Brexit, and all the worst fears that everyone had came true. That obviously looking back on it now is easy because that didn't happen. Mm-hmm. But I don't think you can really judge your decisions based on those market outcomes, because you have no control over what the market's going to do. So I think just having the process in place where you're going to do the same thing regardless of what the market does. And so, you have these sort of guidelines in place ahead of time, where if the market falls, 10%, or if the stock falls 10 or 20%, I'm going to buy more, or I'm going to sell here. So I think just having those sort of regulators in place ahead of time, and so so every once in a while the market is just going to tank for whatever reason. So I think understanding what you're going to do ahead of time is a huge part of the sort of process over outcomes mindset.
Right. Okay, so in chapter 3, you stated, and I quote, "True risk is that which is irreversible," end quote. What do you mean by this?
Yeah, and this was something I stole from, I've been referencing Warren Buffett a few times here. So he has this quote that people reference quite often. He says, "I have 2 rules for investing. The first rule, number 1, is never lose money, and then number 2 is never forget rule number 1." And I think people read this quote the wrong way, because Buffett's lost plenty of money over his career. I showed in the book, he's had 40% plus drawdowns in Berkshire since the late 80s alone. But the thing is that he never sold, so he didn't sort of lock in his losses. So the way I view it is volatility in the market is temporary, but panicking or getting really greedy can have a lasting impact when you make a huge mistake at the wrong time. So those sort of panicky decisions you make, that's the stuff that's irreversible. So I think when you make a poor decision at the wrong time, that's when true risk sort of rears its ugly head.
Mm-hmm. Well, what do you tell someone who, like, let's say they have their portfolio, and let's say they're in a stock where it's down 20-30%, and they're just like, oh, I hate this stock, and and they're thinking about getting out because they want to buy another stock because they're already fully weighted, or they have all their cash deployed. What would you tell somebody in that case, who's like, all right, but nothing's changed in the company itself.
Yeah, I think the ability to know when to sell is really tough, because I think it's much easier for people to buy,
Mm-hmm.
to buy beaten down names or high quality companies. That's the easy part. Like, knowing when to sell, I think that's what can separate a lot of investors from others. So I think in that sense, when you have, you don't have a lot of capital to deploy, I think you really have to just look at your opportunity set and understand, if I'm starting from square one and I'm just going to ignore the fact that this stock is down 20 or 30%, if I'm having this 5 or 10% slug of capital to put to work, would I put that to work in this company again, or are there better investment opportunities out there? So I think you just have to have this idea of having no sunk costs, where not even putting the fact that you've already spent money and lost it in this stock, So I think you have to avoid that mentality of trying to figure out, well, do I wait and hold it until it gets back to even? So I think you have to just always sort of view your portfolio as, starting from ground zero, and would I put money in this today if I had that money between this choice in cash or another stock or another, security.
Mm-hmm. And going back to this idea of risk again, how would you say it's? I mean, this might be somewhat of an obvious question, and but how would you assess risk in terms of the different asset classes? Versus when you talk about micro caps versus small caps and mid caps. I mean, as someone who's kind of gone across the board, how do you assess risk, and also how it pertains to the individual investor?
Yeah, I think if you're talking about different sort of market caps and asset classes within stocks, I think you just have to understand that with much smaller names, you're going to be dealing with a much wider dispersion of results between the sort of best and worst performers. So I think that gives you more opportunity to make money, but maybe more opportunity to lose money as well. So I think you really have to know what you're doing. So I think that's it's just, I think things are going to be more volatile in that space. So I think, going into that with that mindset, understanding that ahead of time is a big part of it. Just knowing that, it's going to be part of, the experience in that, especially if you're in it for the long haul. You're just going to have to be willing to accept volatility. But another sort of idea from William Bernstein, who I mentioned earlier, he says that there's two types of risk. There's shallow risk, which is basically, short-term volatility, a bear market that eventually is going to come back. And then there's deep risk, which is the risk, again, that this sort of irreversible, that you make a poor mistake at the wrong time, or the company goes out of business, or something, really terrible happens. So I think you have to sort of understand the difference between those two risks.
Mm-hmm. So in the book, you also talk about, various Wall Street myths, and this is one of my favorite chapters, actually. And I've heard most of them. And what would you say? What myth would you say most investors are susceptible to? And in microcap stocks, what would you say is the biggest myth out there?
So just for investors overall, I think the one that I sort of latch onto most is that people always say that the stock market is like a casino. But I don't really buy that one, because I don't think that an intelligent investor is really gambling. Maybe there's some speculation involved, because you never know what's going to happen in the future. But at least at the casino, you know what your probabilities are. You know exactly what your chances of winning and losing are. In the stock market, you don't know that. But I don't really follow the idiom that the market's rigged. I think a lot of times, our emotions are rigged, but not the market. So I don't really buy the fact that the stock market is a casino. I think cycles are just a natural extension of a capitalist system. So I think that's just something you have to get used to, the ebbs and flows of things going up and down. I guess the biggest myth for microcaps, I think there are a lot of sort of myths out there, and I think a lot of people that don't understand the space probably assume that there's a lot of sort of scammy stuff going on, and there's these pump and dump things, and I think a lot of that has probably been cleaned up. I'm sure you can talk to this more than I can, that there's still some of that around there, but a lot of these are businesses that are potentially one day going to grow to be much larger businesses. So I think that there's just a much larger runway in that space. And again, there's going to be a lot more failures there as well, because dealing with larger mid caps, you're dealing with much more mature companies. So again, I think the range of results is much bigger. But I think there's probably too many people that correlate microcap investing with penny stocks, and I think that that's just not the same thing.
I couldn't agree with you more. That's actually a very good assessment, and it's not, and it's the myth is also derived from, I'd say, a lot of how the media has been represents, like when penny stocks is in the media, which is also rare. You see it in like Wolf of Wall Street, and poor examples like that, and more bad actors, and that's really the problem when it comes to microcap investing, and why it's not as well known as it maybe should be, as a place to at least get started. I mean, I don't know. Do you agree with what I'm saying there?
Yeah. Oh yeah. Yeah. And I think especially for people trying to understand, how the markets work and how businesses work, I think you can do a lot worse than sort of dabbling in stock picking, especially when you're first starting out, because I think it really helps you understand how businesses function and how the sort of market as a whole works. So I think even using if you're not willing to devote your entire sort of because I think a lot of investing comes down to time management too, and how much you're willing to put into it. But I think even if you're not willing to put in the time to be a full-time stock picker, which I think if you're gonna do it, I think you have to be able to put in the time and effort. I think even taking a small portion of your capital and trying to understand businesses, I think it's a great way to learn how markets and the businesses function.
Mm-hmm. So when defining one's microcap investment philosophy, what questions do you think we should be asking ourselves?
I think from a high level, I think a lot of people, they sort of miss the broad stuff up front, like understanding their philosophy and the policies that they're going to implement, and they just want to get their hands dirty and make some money and pick stocks. And so I think you have to really understand your core investment beliefs and what they are. How many stocks you'll own, when you're going to buy and sell. I think having those sort of guidelines in place up front, I think that's part of it. I think you have to understand the potential risks anytime you're going to pick an investment philosophy. You have to understand whether it'll suit your personality or your individual circumstances. Because again, if it can be the greatest strategy in the world, but if it's not suited for you, it's never going to work, because you're not going to be able to stick with it. And then I think you need to know, what are your constraints for turning that overarching philosophy into an actual portfolio? Because there's a big difference between a philosophy and a strategy. Philosophy are kind of your broad values and principles, and a strategy is how you're going to actually implement it in the real world and follow it. So I think understanding how to turn that philosophy into an individual portfolio is key too.
Mm-hmm. So if I could just follow up on that real quick, like what do you think is like the main question that you should be asking yourself? And I think you mentioned in the book something along the lines of like, how much are you willing to lose? I think that I might be a little off, but what was that, like that one main question we should all be asking ourselves?
Yeah, I honestly think the main question comes down to, can I stick with this strategy? Can I sort of tune out the noise and not care what everyone else is doing, and just understand, is this for me personally, and not really care what everyone else is doing, and not have that sort of greed and fear and envy of what everyone else is doing. I think just understanding whether it's right for you or not.
How do you tune out the noise? I know we all have different ways of doing it, but like for you, for instance, I'm sure that was a process over time. How do you tune it out?
I think that there's a couple ways. I think for some people it comes down to just being completely ignorant and not looking at their statements very often, and just letting things go, and just looking at their account statements once a year and completely tuning it out, because the people that get into trouble are the ones that just start paying attention when things start to go wrong, because then they make emotional decisions and they're not really thinking things through. For my perspective, for me personally, what's helped is that I'm involved in the industry and I see this stuff every day and I read it and I'm writing about it. And it's almost like I'm so immersed in it that I can kind of see through, and I have like a better BS detector where I know when something is not for me or it doesn't make sense. So I think it's almost like an all or nothing proposition for some people, where either you completely ignore it or you follow it so closely that it doesn't impact you as much anymore. So I think it kind of comes down to understanding yourself. But I think for most investors, it comes down to having a filter in place and understanding what you're going to own, why you're going to own it, and what more importantly what you won't own and why you're going to avoid it. So I think that's half the battle is just having those filters and guidelines in place to understand the places that you won't go into, even though maybe other people are, and it sounds exciting and new and interesting, but it's not for you.
Mm-hmm. No, this is. I'm glad I'm really happy that you brought that up, and this concept and your experience, because this is one concept we talk about a lot on here, and I enjoy hearing how everybody does try and tune it out, because it varies. On what it's from one person. It's I delete my Twitter on my phone for for a week.
Yeah, right. Yeah. That's what you have to. Some people have to. I go to the gym at lunch every day, and I see these people running on the treadmill, and they put a towel over it so they can't view the time, and that's like their psychological trick to maybe run a little longer, because otherwise they're going to stare at the clock and it's going to kill them. So I think something like that, where people have to figure out how do I sort of blind myself to my own biases and sort of avoid it at all costs, whatever my sort of vice is or whatever. So.
That's a good trick. I'm gonna do the towel over the time thing. I'm always susceptible to that one.
Yeah.
I try and time it when there's a game on. You know what I mean? But
yeah, there you go.
So in chapter 7, where you discuss the concept of asset allocation. What are your thoughts on diversification versus a concentrated portfolio? And I'm gonna preface this with we talked about this a lot on the podcast, but in your book, you have a very interesting perspective on this. So with that, what are your thoughts?
Yeah, I definitely, my perspective is from a diversified investor, where I think diversification is my way of admitting I have no idea what's going to happen in the future. But I think it really comes down to understanding yourself again, because when I started out investing on my own, I very much ascribed to the Warren Buffett, Charlie Munger approach of, owning a few core businesses and following those businesses. And I just quickly realized, as much as I wanted to do that, it was kind of fitting a square peg in a round hole for me, and it just didn't work. And so I sort of, diversify widely now. I think in terms of thinking about, a concentrated versus a diversified portfolio, I think one of the things people have to realize is that, you give yourself a much higher chance of outperforming with a concentrated portfolio. But it's also a wide range of results where you could underperform as well too. There's actually a study in one of my favorite books about Buffett. It's called The Warren Buffett Portfolio by Robert Hagstrom. I don't know if you've read it, but it's probably one of my favorite books about him. And he did this study where he took these computer simulated portfolios. So he took the Russell 3000, 3,000 largest stocks, and he simulated portfolios, and he did one of 250 stocks, one had 100 stocks. There was another one that had 50 stocks and one that had 15 stocks. And what he found was that by far the biggest range of results was the one with 15 stocks, which makes sense. Whereas the 250 stock portfolio was more like a closet index fund. But also the 15 stock portfolio outperformed much more than the larger ones. So I think that's just the understanding that you have to have, is that you're going to give yourself probably a more volatile ride that way. But if you kind of know what you own and why you own it, and you understand that going into it, I think that is, been shown to be one of the ways to sort of beat the market if that's what you're going for. So I think it just really comes down to understanding if that's for you, and if you have the sort of time and energy to put in the time to do that.
Well, I wanted to bring up this point because it kind of ties back to what you said, or to what's written in the book. I think it was either in the preface or chapter 1, where it's this idea of, there's different tiers of investors that you point out, like there's the 10% that are like the really successful ones, and then there's I forgot what the percentage was, but it's like you're doing just a little bit better,
Right.
and it seems that kind of ties in with this diversification strategy, whereas more of the concentrated, what you would say is like the 10% above. I mean, that might be just my own derivation, but would you how would you calculate that?
Yeah. So there's one of my favorite quotes. There's this quote from Benjamin Graham, and he said, to achieve satisfactory investment results is much easier than most people realize, but to achieve superior results is much harder than it looks. So I think people just have to understand that continuously going for the home run is going to be something where you're probably going to strike out too a lot. So you have to understand whether if you're going to go for those home runs, you have to be willing to accept failure much more often. Whereas on the other perspective, you could be going for more for singles and doubles and being a consistent investor. So I think it's just about sort of understanding where you fall on that spectrum, and it's a lot of that has to do with your own sort of risk tolerance and risk profile and time horizon, and sort of personal makeup for accepting those.
Mm-hmm. So Ben, this is a fun question that I love asking all my guests. What's an experience that you when in the markets that you would say that you learned the most from? What was that for you?
For me, I think it was definitely, early on in my career, I took a new job with an endowment fund in July of 2007, which was about 3 months before the market completely collapsed. And so I think living through the crisis at a younger age, at a younger point in my career, was really helpful for me because I just saw all these people who'd been in the industry for decades and decades, making mistake after mistake, and so I realized that experience can help in the markets, but there's always going to be something new that comes along that will completely blindside you. So I think coming from that perspective of never having lived through something like that and seeing it at a young age, I learned a lot from that experience of seeing how markets react to a crisis. Mm-hmm. And getting again an understanding of things can get a lot worse or better than you expect. So I think going through that and understanding the emotions of what happens in a panic was really helpful for me.
So can you draw back on like one moment where you found yourself just being like, whoa, this is when this happens, like, wow, I can't believe this is happening right now. I'm gonna bank this one for a later time period. Like during that time, what do you have one where that happened to you?
Yeah, there was definitely times where we would get on especially I remember in September and October when the government was trying to pass all these different programs to sort of bail the market out and bail out the banks. We had a few instances where we had a fund or two that was basically about to go under, and you realize that all the stuff that you see in these pitch books from these investors about their process and about how they have an edge and all this stuff, I think sometimes that goes out the window when they make mistakes, when they get over leveraged, or they invest in things sort of that they never should have in the first place, and they didn't really follow their process. So we definitely had some scary talks with some money managers, where it was kind of hard to believe that a few weeks ago they were trying to convince us that everything was fine, and then 2 or 3 weeks later they're close to going under, especially with some of the banks and stuff that we worked with. It was really just a crazy time to be involved in.
Mm-hmm. So Ben, what are the main takeaways you'd like anyone who has read or would like to read your book to walk away with?
Yeah, I think that my main takeaway from all my experience in the markets is just that I think a simpler approach is better for the majority of investors. Again, I think that complex markets don't always require complex solutions. But on the other hand, a simple approach, I think is harder in many ways because it's definitely not easy. It's not easy to sort of follow a set plan when everyone else is doing what they want and sort of not following the herd. So I think that sort of whole notion of investing being simple but not easy, because anytime you invest in the stock market, it's impossible to make money without losing money on occasion, and it could be that you're going to lose a lot of money. So I think having the sort of intestinal fortitude to stick with it through something like that, where you're going to lose a lot of money, but it'll hopefully make you more in the long run. It's a tough experience, and it's very emotional and psychological. And I always tell people that if I would have done it again, I studied finance in college. If I had to do it again, I probably would have at least minored or majored in psychology, because it's so much of a bigger piece than most people realize in sort of understanding who's successful and who's not in the markets.
So Ben, for more information about you and to buy A Wealth of Common Sense, where should my audience go?
Yeah, my website is just awealthofcommonsense.com. The book is by the same name. You should be able to find it anywhere that sells books, Barnes & Noble or Amazon, or it's a link on my website. So you can find all my writing there. And I also have a weekly column for Bloomberg View that you can find. I actually just had a piece out this morning, so I'm writing there as well. Cool.
And are you on social media? You have a Twitter handle?
Yeah, social media. My Twitter handle is at A Wealth of CS, and yeah, I'm pretty active there as well. So feel free to find me there.
Well, Ben, thank you again so much for joining me today on the Planet MicroCap podcast, and I look forward to speaking again soon and to reading your next book.
Yeah, it was a pleasure. Thanks for having me.
No, thank you, Ben. Thank you all for tuning in to the Planet MicroCap podcast, and thank you, Ben, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.